We've got an award-winning fund manager on to help you make the rich list next year. While the Australian dollar is trading near a 13-month high, investors are betting the central bank will raise rates 50 basis points by December. Interest rates in Australia are currently at 3% higher than in the US and Japan. So, is the South Pacific nation an attractive place for investors? Joining me now from Sydney is Lindsay Jones, portfolio manager at Lanterne Strategic Investors. The Lanterne Fund won the best long, short and absolute return fund category at the Australian Hedge Fund Industry Awards. First off, Lindsay, congratulations. Let's take a look at the benchmark, the Aussie, up 26% year-to-date, underperforming most of Asia. How do we position ourselves to maximize returns? What strategy should we adopt?
Well, I think the averages are sometimes a bit misleading, and you have to look into those and see the opportunities that lie underneath. We tend to trade predominantly the top Australian stocks, the top 100 stocks, and within that set there's been quite a big divergence, and we expect there will be quite a divergence between here and the end of the year. So we tend not to look so much at the average overall, but really opportunities at the individual company level.
So there's been a divergence. How do we make sense of that as an investor?
I think if you look at where we are in the cycle and where we've been in the last 6 to 12 months, there are distinct movements of different sectors at different points in time. Towards the end of 2008, everyone was very defensive after Lehman last year, and after wobbles about Citigroup in November, people would tend to be pretty defensive. They were nervous about resources and commodities, thought China was slowing down a lot. That's changed quite significantly now. People generally speaking are optimistic about China and the urbanisation of Asia. So those stocks generally speaking are well supported. To date, the Australian consumer has held up well. That's given a boost to consumer stocks here. The government stimulus has played a big part in that, and the way we see it, that's a reason for some caution. But I think the way we would look at it is trying to understand what's happening at more of a macro level and distilling that into some specific themes, which then give us some hints of which parts of the economy and which parts of the stock market look interesting.
We had the winner of this year's Australian Hedge Fund of the Year earlier on the show, and let's listen in what he had to say.
There was a number of signals through the markets, we think, early or late in the first quarter this year that intimated to us that there was dramatic amounts of capital being put to work. So we took a lot less protection and took on a fair amount of risk for our portfolios.
Lindsay, John Core suggesting that we assume more risk. Question is where and how?
I think at this stage we are somewhat cautious overall. We would agree with John at Fortitude that there is still a lot of cash sitting on the sidelines. The most recent numbers we've seen for the local pension fund sector from the middle of this year suggested they had still nearly 20% of their portfolios in cash, and they are a big driver of the market here. So at that level, there are reasons to think the market will be well supported, provided people are feeling generally comfortable. If economic data continues to be benign and we don't have any negative headlines about the banking system or about the growth rate in China, then I think that weight of cash will make the market keep rising across many sectors, but particularly those that are exposed to the urbanisation of Asia, China in particular. But if we look at the overall picture, we are cautious at this stage because we do foresee the possibility of some of those headline risks, whether it's a moderation of growth or whether it's some second-order troubles in the banking system in the Northern Hemisphere, or a slowdown in the Australian context, a slowdown in consumer spending. As I mentioned a moment ago, the Australian government has underpinned consumer spending for the last 9 months, and if that slows down, that could cause a few wobbles.
Lindsay, your stock picks, Boart, long year, 80% up year to date, 7 of 8 analysts calling for a buy or hold. How confident are you the company will turn around after posting a loss in the first half?
We're very optimistic on Boart. This is a stock that provides services to the mining and exploration sector. A lot of its client companies are mid-tier mining companies, and they were hard hit in the last 12 months through a combination of fears about demand for their end services and also restrictions of access to capital so they could fund their activities. Both of those things are looking more positive now, and Boart itself had some big problems with its balance sheet. It's raised a lot of capital recently. It now has a very manageable debt position. And so we think it's favourably exposed to a rebound in mining and exploration activity, and provided that plays out, we see a lot of upside for that stock.
In 20 seconds, Oz Minerals, liking it?
Yeah, I like that one a lot. Again, big balance sheet problems, nearly went under, sold off most of its assets. One key asset remaining, which is heavily exposed to copper, which we're positive on. Also, 40% of the balance sheet is in cash, so we think it's an interesting play potentially as a takeover target or to make some good buys downstream in its sector.
Lindsay Jones, thank you so much for that. His liking Boat,
Thank you.
Oz Minerals as well as Telstra.